because of the geopolitical issues around Russia, a number of countries have made also some degree of strategic decision that they might want to be careful about how much they hold in treasuries because the United States could essentially shut off their money. And that's a separate issue from what you think of the conflict, but it's just that basically when sovereign nations realize that their reserves are subject to bank freezes, essentially, right? I mean, if you're in a jurisdiction where your bank account can be frozen, you might think twice about how much you want to put in the bank. You might want to have some money in some of your self-custody, physical cash, gold, Bitcoin, silver, whatever you want to do. You might think twice about how much you put in your bank account. Similarly, sovereign nations are maybe thinking twice about how much they want to hold in freezable assets, and they either want to diversify, right? So Russia says, okay, we're going to hold money in Chinese, assets to some extent, or you have other countries say we're going to own some gold and we're going to self-custody it because nobody can shut off the gold if we own it.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 10th through January 17th, 2023, while supplies last. This week we feature the 2022 Silver Krugerrand at $3.99 over spot, and the Valcambi Silver Kilo Bar at $2.99 over spot per ounce. For years, the Krugerrand was the most known bullion coin in the world, and in 2017, the South African Mint and Rand Refinery began minting a silver counterpart to the famed gold Krugerrand. The 2022 Silver Krugerrand bear the Springbok on one side and the portrait of Paul Kruger on the other, and have a face value of 1 rand. They come 25 to a tube, 500 to a monster box, they are IRA eligible, and are renowned for recognizability and design. Best of all, they are only $3.99 over spot. Next, from Valcambi, a Swiss mint known for producing some of the highest quality products in precious metals, we have the Kilo Silver Bars, which are 32.15 troy ounces of 3/9 fine silver, cast with individual serial numbers and a beautiful antique-style finish. They are only $2.99 over spot per ounce, they come 15 to a box, and are IRA eligible. And if you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're honored to have this widely followed guest, Lyn Alden, the founder of Lyn Alden Investment Strategy, joins us this Wednesday, January 11th, 2023. Lyn, thanks for coming back on Liberty and Finance.
Happy to be back. Thanks for having me.
It's been far too long. We get a lot of inquiries from our viewers about what your thoughts are on topics that we do discuss with our guests, and we'd love to get you to weigh in on some real heavy hitter topics here. Despite reassurances from officialdom, as we have Fed presidents constantly reassuring us that all is well or all will be well if we just trust them and hold on, you've been looking behind the scenes into some serious concerns around both our decelerating U.S. economy and around liquidity concerns, both at the central bank levels and the Treasury levels. If we could address those, it would be very illuminating to me and our subscribers. First, if you could tell us what you're seeing about the U.S. economy. There's been lots of confusion and concern on people's parts about whether we're just hurtling forward into this runaway inflation, and whether the economy is rebounding or soft landing or whatever you want to call it, versus no, we're heading down on the economy, and that may be deflationary, et cetera. Can you tell us what your latest research is guiding you to in that area?
Sure. I think it's a matter of managing different time frames. So, for example, you can have a view about what's going to happen over a 3 to 5 year period and a separate view about what's going to happen over a 6, 12, 18-month period. And I think that's part of the confusion right now. So, for example, I have a longer-term inflationary outlook, but a nearer-term economic slowdown, recessionary type of outlook. And when we look at recessions, a lot of people think in Boolean terms, like either you're going to have a recession or you're not. Whereas, perhaps a simpler way to look at it is the economy accelerating or decelerating, and what do the leading indicators say is likely to happen in the coming quarters? So, for example, in the past, say prior to the whole COVID crash, that whole 2010s decade of economic expansion, we had what was technically an economic expansion for over a decade. But if you look at the acceleration and deceleration figures, we actually had 3 mini cycles. They were roughly at 3 to 4 year increments within that 10+ year economic expansion. We had a couple near recessions and things like that. And so not all economic decelerations become recessions. Sometimes they're averted, sometimes they put stimulus in, sometimes they juice it up to keep it going. Other times it does fall into a recession. And so what we can pretty much say, with obvious certainty is that since 2021, the US economy has been on one of those decelerating paths. And so, for example, you can look at the Manufacturing Purchasing Managers Index, PMI. That looks like a sine wave. It kind of ebbs and flows over, say, 3-year periods roughly. That's been in a clear downtrend since kind of the middle of 2021. And in the past couple months, it's entered contraction territory. So it's just below 50, contracting. That's generally where it gets to in economic decelerations if it stops there, right? So if it starts to roll up, you can get kind of a slowdown, but not a recession. If it keeps going down from here, that's more indicative of actually becoming a recession. There's a number of other, the Conference Board leading indicator, for example. There's a number of different economic indicators that show sharp deceleration with a high risk of recession, later this year. And the warning signal that a lot of people focus on is the 10-year minus 3-month yield curve, and that's often a differentiator between an economic slowdown and a recession, because that usually does not flash an inversion warning sign during those slowdowns that don't become recessions, but that does tend to flash before an actual recession. And so, for example, in the past 10 years that I talked about, those various ebbs and flows, none of them had inverted yield curves until you got into that 2019 period, which is when it started to signal potential recession. That's when you had the Fed starting to cut rates, the famous Powell pivot, and that was all pre-COVID crash. We were basically already showing signs of recessionary indicators. And so I would say right now we're in a clear, it's obvious downtrend. And the big question is whether or not we'll turn into a full-blown recession or not. I would say that more indicators suggest that we are going to probably enter recessionary conditions rather than not.
In the more likely than not recession that you see approaching, what would be likely outcomes both from the equities as well as perhaps real estate that people should expect in that kind of environment?
So I think it's more likely to be a stagflationary type of recession, maybe a longer, grindy recession, kind of like the 2000, the post-2000 recession, when you had that kind of a long bear market. You had instead of like an epic economic crash, you had like this malaise, this grinding contraction that played out compared to say the blow up in 2008 or the abrupt shutdown of 2020. And one thing I look at a lot is the banking sector, basically determining the health of the banking sector. And so going into the 2008 crisis, the banking system was the unhealthiest it had been since literally the 1930s, right? So you had basically the most leveraged banking system like in our lifetimes. And you can measure that in various ways. You can look at, for example, bank loans as a ratio to the base money, right? So the monetary base. How levered is the financial system? That's one way of looking at it. Another way of looking at it is you take all bank assets and you say what percentage of them are in nominally risk-free assets. So treasuries and cash balances at the Fed, right? Those are technically in the way our system works. They're not inflation protected, but they're nominally considered free of default. What percentage of their assets are in those? And going into that, 2006, 2007 period, you had record low allocations to those nominally risk-free assets, which meant record high allocations to things that can default. So loans, riskier securities, things like that. And so what we see here is that, after the banks were recapitalized after that whole event, now bank balance sheets are healthier. They're basically, they have a historically high allocation to treasuries and cash at the Fed. And they have, pretty low allocations actually relative to their full asset base compared to loans and riskier securities. And so the way I would describe it is that, to the extent that we have a recession, we're unlikely to have a financial crisis that starts in the banking sector, right? So last time, the 2008 crisis, it emerged from real estate, from banking, and now it's likely to materialize in other places. And one of the differences you have between a disinflation or a deflationary crisis versus an inflationary one is that health of the banking system, right? So this is more likely, if you don't have that problem in the banking sector, and instead you have problems elsewhere, public finances, energy sector, things like that, that could actually more likely translate to a stagflationary type of recession. So I would say that we're in the more grindy type of recession most likely, rather than this big banking implosion that a lot of people are maybe looking for.
Well, one of the things, I mean, there's two sides to every coin, and metaphor isn't perfect here, but anyway, if the banks have more stable balance sheets currently than they did then, is it because they've already drawn in their horns, as Alistair MacLeod would say, and are less confident that of wanting to lend out right now, either to businesses or to other banks, et cetera?
So yeah, and it depends on what time frame you're looking at. That's kind of been the story for the past decade. That combination, there were regulations put on them that changed their risk profile, but then also just on their own devices, they were more reticent to lend. So that's like the longer term story of the past decade since that crisis. But then in the more cyclical sense, generally this is another kind of recession indicator, is that they do surveys every quarter of banks, and they say, are you tightening lending standards or are you loosening lending standards? And they kind of weigh the percentage of banks that are answering one way or another, and then they break it down. Are you more likely to lend to large firms? Are you more likely to lend to consumer credit? Things like that. They generally all go in the same rough direction. And what we're seeing right now is that banks are very much tightening their stance. Now, they did that back in 2008 too, but they did it from a position of weakness, whereas now they're doing it from a position of relative strength. And that doesn't mean that banks can't be impacted negatively by a recession. It just means that the recession is unlikely to emerge from the banking sector. They can still be impaired by, business going out of business. They can't pay the loan back to the bank. So banks they can have loan losses, they can have impairments and things like that. But the difference is that it's unlikely to emanate from the banking sector, and instead it's more likely to emanate from other areas in the economy.
Could you focus for a few moments? You gave one example there, struggling businesses unable to pay back their bank loans. What other examples are there of areas that you foresee it's more likely than from the banks for the major serious impacts of a coming recession to emanate from?
So right now, because rates went up so high, we have the rate-sensitive industries that are particularly impacted, right? So even though housing prices haven't fallen sharply, housing activity has. So number of new starts, number of people buying and selling homes, because everybody's got these locked-in mortgages. Nobody wants to sell the home they have, and then also for new buyers, they're very unaffordable because you have the same house price, but now you have twice as high of a mortgage rate, and so that whole industry's dried up. So if you work in mortgage originations or home builders, you're probably not having a great time right now. Same thing is true for auto loans. That most people buy them on financing, or at least a high percentage of people buy them on financing, and so if the rate doubles, that makes them a lot less affordable, and you get slowdowns in people buying new cars. So those are sensitive. In addition, the technology sector, people often try to think of it as a non-cyclical sector, but it actually is pretty rate sensitive because, in an environment of basically zero rates, if the 10-year Treasury yield only pays you 1%, there's basically no cost of capital. And so investors are willing to pay very high valuations for these long runway, unprofitable growth companies. And then the way these growth companies operate is they say, let's keep prices low. Let's just generate as much growth as possible. We don't have to worry about profitability. And instead, we'll keep issuing new shares to pay employees, for example. We'll give a big percentage of their compensation will be new shares that are highly valued and they keep going up. And the problem is that when you do get a cost of capital, if the 10-year Treasury is 3%, 4% higher, now suddenly you have to re-rate those equities at lower valuations. You actually have a positive discount rate that you're comparing them to. And so those equities go down a lot more than, say, value stocks do. And the company can no longer just keep issuing more and more shares to employees and keep them on the payroll. They actually have to pay their employees more of a salary type of situation. And so they have to raise their prices to try to be more profitable. They can't rely on that constant issuance of equity at the same rate that they were. But then the problem is when they raise prices, their growth slows down because it's kind of like part of their growth. Even though many of them do have good technology, they are growing, but their growth rates were inflated by the fact that they were never pricing appropriately. And when they actually start having to pricing appropriately, you get closer to the true growth rate of that product or service. And so you're seeing layoffs in the tech sector because a lot of these companies are not growing as fast as people thought when you don't have this level of free capital malinvestment. And so I would say housing, auto originations, and the tech sectors where you see employment weakness, whereas you still see relative strength in many other services. I mean, restaurant spending is up, travel spending is doing well. Those are areas that are still holding on, whereas you have weakness in a lot of those other types of more rate sensitive areas.
And I think if I heard you correctly, you near the beginning of that section, you talked about investors willing to buy buy and hold tech stocks, knowing that they're not going to be turning a profit anytime soon. They're just keeping your foot in the door on the ground floor and thinking they're going to be building market share percentage, and I just want to be on that bus. I just want to be on that train because I think it's going to end up someplace big. That was what we saw during the .com boom with companies like Amazon, et cetera. They weren't turning a profit at all, but you had to own it because you knew that was the future. But you're saying that the same investors are going to be less willing. They're not willing to pay up and buy those rich shares and hold for a long time in a non-profitable company in an area of higher interest rates.
Yes, and it's a spectrum, right? So, for example, in a new tech startup, it's normal to be unprofitable for the first few years as you're ramping up your revenue. Your expenses are relatively fixed; they're growing more slowly, and so if you do achieve a level of success, then you eventually start becoming profitable. The problem comes, not every company is going to be the next Amazon, right? That's one in 1,000, maybe less, and instead, a lot of companies will fail or they'll reach some sort of middle level and then they're kind of stagnate from there. And so in a normal startup environment, you have a number of years of unprofitable growth, but then you're expected to become a more self-sustaining business. And the problem is that in a super low interest rate environment, that unprofitable phase is allowed to be extended a lot longer. Investors give them a lot more runway. And when suddenly you do have a cost of capital, suddenly that's no longer viable. You can't just keep issuing hot equity. It's going to be a lot cheaper equity. Employees are not going to be as well compensated just by being their equity balances, all of their stock options are not just going to keep going up. And so that the actual reality kind of sets in for those businesses. We find out which percentage of them are actually, say, the next Amazon versus which percentage of them were really only growing because of a cheap money environment. And they actually weren't as good as they seemed. And there's going to be a significant percentage that unfortunately fall into that second category.
And you mentioned that this can result in pressure on the banking system through non-performing corporate loans, for example. But you implied again in very quick passing there that large scale, tens of thousands of employees per each of these large companies layoffs could result in lots and lots of consumer level loan defaults as well. Is that another exogenous pressure on the banking system then?
Yeah, and it can ripple through. So, for example, not only do those people default on some of their loans potentially, but then they spend less elsewhere. And then other businesses can face slowdowns. And then some of those, if they're junk rated, if they're already kind of on the margin, that could be the breaking point for why they are unable to pay back a loan. And so it ripples through the economy. And so, I'm not expecting massive loan loss, say, next month. But basically, if we do continue to slow down, which is currently no signs that we're reaccelerating, if we do continue to slow down, you're more likely to get that rippling through the economy where it starts in the weak sectors, but then it impacts even the reasonably strong sectors because a lot of their customers work in those tech companies. They work in the housing. They work in auto lending, things like that. So it ripples into the rest of the things that aren't necessarily directly affected by rates.
So we've been focusing so far on a macroeconomic view and talking about the banking system and the consumers as well as tech companies. What about liquidity at the sovereign level? I guess particularly the Fed and the Treasury. It's been just baffling to most people. And we feel like we never really get leveled with. Back when we had the repo crisis back in September of, was it 19 and it's like all of a sudden some extraordinary actions had to keep happening on a nightly basis. Oh, no, nothing to see here, folks. Just go about your business. Everything's fine. We're just throwing all this oil into the gears here. Can you tell us about what's really going on behind this very large curtain of the Fed, the central bank, and the Treasury in terms of liquidity and the ways that you're ferreting that out?
Yeah, so there's different ways to measure liquidity. There's global liquidity indicators, and then there's domestic liquidity indicators. And so here we can focus for a second on domestic liquidity indicators. And when you think of the way the fiat system works, there's different types of moneyness, right? There's bank reserves, there's broad money. Even T-bills can have a sense of moneyness. When you think of cash equivalents, a lot of people will put T-bills or money markets into those, even though those are technically short-term debt instruments. Rather than actual cash, right? So there's different types of these money-like assets, and the Fed and the Treasury basically adjust the ratio of how these compare to each other. If you have too much of one and too little of another, you can start to get basically like one of them squeezed out. And so back in 2018, and 2019, the Federal Reserve is was performing quantitative tightening. So they were reducing their balance sheet. They were essentially selling treasuries. Now in practice, they were letting some of the treasuries mature and then not use the finances to rebuy them. So but all intents and purposes, they're selling treasuries, which means they're basically destroying base money, and they're doing the opposite of money printing. They're destroying some base money on a gradual basis, and that's sucking liquidity out of the economy. And they were able to do that up until you had the September 2019 repo spike. And so that's basically this overnight lending rate that blew up. And a lot of people are like, oh yeah, like you point out, they were kind of obfuscating the issue. They were like, oh, it's a technical issue, don't worry about it. I was actually covering that pretty closely at the time. There was another analyst, Luke Groman, that made really good calls in 2019 about that becoming a problem. And then, when it started to play out, I was paying a very close attention to it. And my analysis at the time was that it was not really a repo problem. It was a T-bill oversupply problem, that the Federal Reserve was going to have to start buying T-bills again because they essentially had a supply-demand mismatch. And a lot of the T-bill purchases were happening, a lot of the Treasury purchases in general were happening from hedge funds using repo financing to buy those treasuries, right? So a problem in the repo market eventually cascades into the treasury market. And so my view was that they're going to have to start buying T-bills. And sure enough, a week later, the Fed says we have to start buying T-bills. And we're not going to call it QE, but we're printing money to buy T-bills, right? So the joke became that they're calling it not QE. And so it's like suddenly a repo problem is actually a T-bill problem. And for people that were kind of looking at that, it was not too surprising. And so that marked the end of their quantitative tightening, and then shifted back to a period of quantitative easing. And that was all pre-COVID, right? So when we got to March 2020, when we shut down the global economy in a large part, you had this, everybody's got in the whole world, they all owe dollars, right? So China lends out dollars, Europe lends out dollars, Japan lends out dollars to companies in Brazil, companies in Egypt, companies in everywhere. Everybody owes dollars. And if dollar cash flows dry up because trade stops, they still owe those dollars, right? And so there's like a dollar shortage. There's a debt squeeze. And what you see in that environment is the dollar spikes in value because all this debt represents demand for dollars. And they go to their central banks, and the central bank says, okay, well, we'll sell some of our reserves and we'll get dollars, and we'll give you some dollars to bridge this gap. And so they rapidly sold their treasuries in March 2020, and that broke the treasury market, right? It just, it basically went no bid. You had people selling, nobody stepping in to buy. And so the Federal Reserve had to come in and buy $1 trillion worth of treasuries in 3 weeks. And so that became the story of 2020 and 2021, which was the Fed was creating new money, buying treasuries, basically financing government deficits, monetizing them. And in 2022, they're trying to go back to the same thing they were doing in 2018, 2019, which is that they're reducing their balance sheet again. They're no longer buying treasuries, at least on net. They're letting treasuries mature off their balance sheet. And so they're essentially sucking money out of the system and forcing the private sector to buy more of those treasuries. And we'll see how long they can go, but I suspect that much like 2018, 2019, they're eventually going to run into something breaking. I don't think it'll be repo market this time. If anything, there's the opposite problem, but I think it'll be just other areas. I think a lot of it's going to show up directly in the treasury market, treasury market illiquidity.
One of the differences over the past 3 years has been a major pivot by non-U.S., by global players, as particularly the BRICS plus countries in the East, of saying, and they've got lots of reasons why, but showing less and less appetite for buying treasury. So in the past, you might have looked to Japan or looked to the Bank of England or looked to somebody to come in and be your angel buyer. But do you expect that to be a missing piece? The cavalry's not coming anymore from overseas because of actions that we've taken.
Yeah, that's my base case. And that's actually even in the prior repo spike. So that whole 2018, 2019 period, once you had an inverted yield curve, you had no more really significant foreign buying. That contributed to the T-bill oversupply problem. And we have a similar problem here. There's one is that, whenever the dollar is on the stronger end, you generally have less foreign buying of treasuries. Basically, they're more like defending their currencies rather than, cheapening their currencies and accumulating reserves. That's number one. And then number two, because of the geopolitical issues around Russia, a number of countries have made also some degree of strategic decision that they might want to be careful about how much they hold in treasuries because the United States could essentially shut off their money. And that's a separate issue from what you think of the conflict, but it's just that basically when sovereign nations realize that their reserves are subject to, bank freezes, essentially, right? I mean, if you're in a jurisdiction where your bank account can be frozen, you might think twice about how much you want to put in the bank. You might want to have some money in some of your self-custody, physical cash, gold, Bitcoin, silver, whatever you want to do. You might think twice about how much you put in your bank account. Similarly, sovereign nations are maybe thinking twice about how much they want to hold in freezable assets, and they either want to diversify, right? So Russia says, okay, we're going to hold money in Chinese, assets to some extent, or you have other countries say we're going to own some gold and we're going to self-custody it because nobody can shut off the gold if we own it. And so there's a combination of diversification and other assets, self-custodial assets, as well as just a general trend that when you do have a strong dollar, you generally get less treasury buying in general.
So what do you foresee likely happening in that area, and what would be the impacts that most people will observe when what you foresee takes place?
So I think in the coming years, we're going to see essentially a deterioration in quality of the treasury market. So we've already seen over the past year really bad liquidity conditions. So basically, that the treasury market's supposed to be one of the most liquid markets in the world. That if you're a billionaire, you can come in and buy or sell $1 billion of treasuries, and it doesn't matter. You don't affect the price because it's a deep liquid market. And what we saw over the past year, and to a greater extent over the past few years, but especially the past year, is how poor liquidity was. Right? There's not a lot of buyers and sellers relative to the size of the market, and so it's easy to move the price around. It's easier for auctions to be messy, where they start selling at one price, and by the end of the auction, they're selling at a different price because there just weren't enough buyers to keep buying at that initial price. And so my expectation is that treasury market liquidity is going to continue to be a problem as long as the Fed is not a buyer, because if you don't have foreign buyers, banks are no longer U.S. banks are no longer buying in aggregate. They were before, but they're not now. And there's only basically the buyers are things like pensions, wealth managers, households, family offices. You have these kind of domestic non-bank entities that are essentially buying what everyone else is either selling or not buying, and that can only go on for so long. There's only so much they can absorb relative to the size of their balance sheet, and then either you would have the Fed coming in back to provide more QE, essentially, kind of like what they did after the 2019 repo spike, or another option that they can do is that they can adjust the supplementary leverage ratio for banks, which is a jargon for saying that they can change how banks calculate their leverage, but only for treasuries. It's a way of banks holding more treasuries, and it's functionally similar to QE, with the difference being that more of those end up on commercial bank balance sheets rather than the central bank balance sheets. So they have a couple levers they can pull if they run into liquidity problems, but all of those are generally pro-inflationary, and kind of generally would trend towards a weaker dollar rather than a stronger dollar.
Boy, we just keep coming up with more and more ways that are not QE, or that we can call not QE. So could you give us maybe your elevator roll up for what you foresee for this year, 2023? It sounds like some major pressures in different areas. Do you see anything fairly dramatic or noteworthy happening that's going to affect ordinary people?
So I think that the labor market's going to weaken to a significant degree. Maybe not to the extent that, say, happened in 2008, but I do think that we're going to get more and more slack in the labor market. We're already showing signs of that rolling over. So, for example, right now, unemployment rate's still low. A lot of labor conditions are still strong. But when you look at leading indicators like temporary help numbers, for example, those have already gone down year over year slightly. And that generally leads broader employment, because if you're a small business, if you're trying to tighten your belt, the first employees you might let go are the temporary employees rather than your longer term permanent employees. And so we're seeing early signs of a weakening labor market. So I would keep watching out for that. That can certainly affect a lot of people, obviously. And I think we're going to see, I expect kind of just stagnant markets, right? There are certainly possibilities where you could rally or you could crash. Whereas my base case is probably just stagnation in a lot of asset prices, where you just have a continued grind sideways or grind somewhat lower, for example, by the end of the year. And you could certainly have these more explosive moments, like maybe, for example, in the first half of the year, if the market starts to price in a recession and you start to get a fall in bond yields, you could get a rally in risk assets. But then when the actual recession materializes and you get weaker corporate earnings, you'd probably give up a lot of that rally. So you could have a situation where you rally the first half of the year and then fall the second half of the year and erase all those gains. And so there's a lot of different directions that this could play out. But as long as, economic indicators point south, and as long as the Fed is withdrawing liquidity, you're unlikely to get fantastic asset price performance in most assets like equities.
You put so much information into each of your statements. They're very dense. One of them about a few minutes ago was about foreign buyers being more and more reluctant to buy treasuries for some reasons that are related to fear of they'll do to us what they did to Russia, freeze our accounts or whatever, and instead investing in assets that they could control, such as precious metals. We've seen just record amounts of accumulation by the BRICS plus countries of precious metals. And do you foresee that continuing in 2023 because the same driving factors are still in place? Because if that's the case, it's interesting that the drawdown on physical availability has been dramatic over the past year and maybe couldn't even be sustained for another year yet. So just wondering if you see the demand side of these international countries wanting to hold on to assets that they can control continuing.
I do see that being persistent. And if you look at if you zoom out, you had for a while, for years and years ago, you had declining gold balances among countries. And so from say, the 80s and 90s all the way into say roughly 2008, you had declining gold balances. And then after the 2008 crisis, you've had, a pretty persistent uptrend in gold reserves among foreign nations. It's like a V shape where you reverse that, and so that's the longer term trend. And then the nearer term, as you pointed out, 2022 was a great year for gold accumulation among these sovereign nations, and I don't see a reason why that would slow down. Ironically, a lot of sovereign nations hold their gold in London or in New York, which kind of partially defeats the purpose because then they have all that counterparty risk. But many of them do self-custody their own gold in their sovereign vaults. And as long as prices are pretty low, prices are like they haven't really gone anywhere in a decade. There's these large paper markets. And so they're saying, well, if the physical is on sale, we'll just keep taking the physical. And so as long as that works, as long as there's stockpiles, as long as they can keep taking the physical without adjusting the price too much, I don't see why they wouldn't keep doing it. And eventually they can run out of, basically you start to get a pricing function if you run into acute shortages and you're unable to meet those requests. But I do think that they're going to continue to accumulate. And a lot of it is, obviously countries like China and Russia are going to, be more gold focused and less dollar focused because they're more likely to have direct adversarial outcomes with the United States. Whereas you have a lot of countries like Saudi Arabia, India, Brazil, where they're not strategic like enemies to the United States, but they want to have their own. They want to be able to choose their own direction. China is now the biggest trade partner with the majority of countries in the world. It used to be the United States, but over the past 20 years, that's flipped over to China for the vast majority of countries. Only North America, parts of Western Europe are still bigger trade partners with the U.S. Vast majority of these countries are bigger trade partners with China, and so they want flexibility to be able to go around and kind of buy and sell whatever they want and without pressure from Washington. So I think even for those types of countries, there's a good chance that they want to be resilient to potential sanctions or actions that could be done against them for siding with interests that the United States doesn't necessarily want. A good example was India, where they were asked if they were going to stop buying Russian oil, and their like energy minister pointed to Sri Lanka, and he's like, literally on our doorstep, this country had severe energy crises. They basically had a collapse of their state due to lack of cheap energy. And so we're going to do everything in our power to get energy as cheap as we can. They're a country where per capita GDP is like $3,000 or $2,000. I forget the exact number. It's a very on a per capita basis impoverished country. And so they're not really pickers or choosers about where they get their energy from. And that's not necessarily something that people in Washington like. And so India wants to be able to maintain its own payment channels and its own stores of value so that it's not necessarily pressured by external nations. And I think that's true for a lot of the BRICS nations.
There's a song from I believe it's from the 60s or 70s, talk about people everywhere just want to be free. It stands for governments as well. All over the world want to be able to take care of their people. And it seems like another example of where the West is promoting ideologically driven business or policies or whatever versus sort of practical basis for driving policies or business in the Eastern world. Lyn, it's fascinating. If people want to get connected, you do some serious analysis and publications. How can people get connected with that?
So I'm at lynalden.com. That's where the majority of my work is. And I'm also active on Twitter at Lyn Alden Contact if people want to follow up-to-date thoughts there. Thank you.
And want to make sure that everybody, if you don't want to miss a single episode with Lyn or any of our other guests, make sure you go to libertyandfinance.com and put in your name, your email address, click submit, and then confirm when you get a confirming email, and you're into our once-a-day free email list. You'll get all of our episodes with all of our guests and any weekly specials. Lyn Alden, founder of Lyn Alden Investment Strategy, thank you as always for joining us on Liberty and Finance.
Thanks for having me.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.